When is the best time to invest in real estate? The answer is simple: right now. Waiting for the perfect market conditions is a common mistake that many aspiring investors make, often leading to missed opportunities and regret. The truth is, no one can perfectly time the market. Instead, success in real estate comes from being in the market over time, allowing your investments to grow, rather than waiting for an ideal moment that may never come. Make sure to watch all the way through, because at the end, we'll provide a practical 90-day action plan to help you stop procrastinating and get started without further delay. The myth of the perfect market. Real estate markets are cyclical, fluctuating based on a variety of factors, such as interest rates, supply and demand, and economic conditions. Many people believe they can wait for the market to hit its lowest point before buying. But the reality is that predicting these cycles is nearly impossible. Even seasoned investors struggle to time the market perfectly. The risk of waiting is that you may miss out on years of potential growth. While you're on the sidelines, prices might continue to rise, making it harder to enter the market later. Additionally, the opportunity cost of not investing, missing out on rental income, appreciation, and equity buildup can far outweigh any perceived benefits of waiting for the right time. As Robert Kiyosaki, author of Rich Dad Poor Dad, wisely said, real estate investing, even on a very small scale, remains a tried and true means of building an individual's cash flow and wealth. This underscores the importance of starting, even if conditions aren't perfect. The power of time in the market. The key to building wealth in real estate is not about timing the market, but spending time in the market. Properties generally appreciate over the long term, and holding on to an investment for several years allows you to benefit from this appreciation. Moreover, each mortgage payment increases your equity, which is like a forced savings plan that builds wealth over time. Consider a story of two brothers, Alex and Eddie. Alex decided to wait for the perfect market conditions, while Eddie jumped in and bought his first property. Eddie's first deal wasn't perfect. He faced challenges with cash flow and made a few mistakes, but 5 years later, he owns several properties, enjoys steady rental income, and has a growing portfolio. Alex, still waiting for the market to correct, is just now trying to buy his first property. The difference? Eddie's time in the market has allowed him to build significant wealth, bringing him well on the way to becoming a Realty Rockstar, while Alex has missed out on years of growth, still practicing drums in his basement. As another example, consider the aftermath of the 2008 financial crisis. Many investors who bought properties at the height of the market saw their values plummet, but those who held on through the downturn and into the recovery ultimately reaped substantial rewards. Property values in many markets have since more than recovered, demonstrating the power of staying invested over time. The same principle applies today. Regardless of market conditions, being in the market is what ultimately builds wealth. Overcoming the psychological barriers of investing. Investing in real estate can be intimidating, especially for those who are new to the market. Psychological barriers such as fear of making mistakes, fear of losing money, and analysis paralysis can prevent would-be investors from taking action. However, overcoming these fears is essential to achieving success. One common psychological trap is the fear of missing out, FOMO, which can lead to either rushing into a bad deal or waiting too long for the perfect one. It's important to remember that no investment is without risk, but taking no action at all is often the riskiest choice. Another barrier is the fear of the unknown. Real estate involves many variables, and first-time investors might feel overwhelmed by the prospect of managing properties, dealing with tenants, or navigating financing. The key to overcoming this fear is education. By learning about the market, seeking advice from experienced investors, and starting with manageable projects, you can build confidence and reduce anxiety. Behavioral finance principles such as loss aversion, the tendency to prefer avoiding losses over acquiring equivalent gains, can also play a role in decision-making. Investors may hesitate to act because they fear potential losses more than they value potential gains. Recognizing this bias can help you make more balanced, rational decisions, focusing on long-term outcomes rather than short-term fears. Strategies for informed decision-making. To succeed in real estate, you don't need to wait for the perfect market. You need to make informed decisions based on current conditions and long-term goals. Here's how. Stay informed. Regularly track key market indicators such as interest rates, local housing demand, and economic trends. This helps you identify opportunities even when the market isn't perfect. Focus on cash flow. Prioritize properties that generate positive cash flow from day one. Even in a less than ideal market, a cash flowing property can provide income and cover expenses. Diversify. Spread your investments across different markets or property types to reduce risk. This way, even if one market underperforms, your overall portfolio remains stable. Leverage expert advice. Build a network of real estate professionals, including agents, lenders, and mentors. Their insights can help you navigate complex market conditions and make better decisions. Think long-term. Real estate is a long-term game. Focus on your broader investment goals rather than getting caught up in short-term market fluctuations. By following these strategies, you can confidently invest in real estate regardless of market conditions, knowing that your decisions are grounded in solid research and a long-term perspective. The importance of long-term perspective. Real estate is inherently a long-term investment. Unlike stocks, which can be bought and sold quickly, real estate transactions take time, and the benefits of owning property often become more apparent over the years. One of the most compelling reasons to start investing now, rather than waiting, is the power of compound growth. Consider a property purchased for $200,000 with a modest annual appreciation rate of 3%. After 10 years, that property could be worth around $268,000. If you had waited for the perfect market and delayed your purchase by even a few years, you would miss out on thousands of dollars in appreciation. Additionally, the equity you build through mortgage payments adds to your wealth, which can be leveraged to purchase additional properties. Historical data supports the resilience of real estate as an investment. Despite economic downturns and market fluctuations, real estate values have generally trended upward over the long term. Investors who held on to their properties during market downturns, such as the 2008 financial crisis, often saw their investments recover and even exceed previous values. This long-term perspective is crucial for real estate investors who want to build sustainable wealth. Understanding market indicators. When you're tempted to wait for the perfect market, it's often because you're uncertain about current conditions and what they mean for your investment. However, by understanding and monitoring key market indicators, you can make informed decisions and recognize opportunities, even when the market isn't ideal. This knowledge empowers you to take action now rather than hesitating and potentially missing out on long-term gains. Here's what you need to consider. Interest rates. Interest rates are a double-edged sword in real estate investing. When rates are low, borrowing is cheaper, making it easier to finance properties and potentially increasing demand, which drives up prices. Conversely, higher rates can cool the market by increasing mortgage costs, but they also reduce competition, which might allow you to negotiate better deals. The key is to understand that interest rates are just one piece of the puzzle. Low rates can be beneficial, but they often come with higher prices, while high rates might offer better purchasing opportunities if you can manage the financing effectively. Inventory levels. The balance between supply and demand is critical in real estate. A market with low inventory typically favors sellers, as buyers compete for limited properties, pushing prices higher. However, low inventory also means fewer options and potentially overpaying for properties. On the flip side, high inventory can indicate a buyer's market, where prices may stabilize or even drop. This could be an ideal time to buy, especially if you focus on properties that are undervalued or have strong long-term potential. Understanding local inventory trends and how they correlate with pricing and demand can help you time your purchase more effectively. Economic indicators. Broader economic trends such as job growth, GDP growth, and consumer confidence are strong indicators of a market's health. A region with robust job growth is likely to see increased housing demand, leading to appreciation and rental income potential. However, it's also important to look at the economic resilience of a market, how well it can withstand economic downturns. Areas with diverse economies tend to be more stable, whereas regions dependent on a single industry can be more volatile. By understanding these trends, you can identify markets that not only offer growth, but also have the stability to weather economic challenges. Rental demand. Rental demand is a critical factor for those looking to generate income from their investments. High demand for rentals typically leads to higher rents and lower vacancy rates, making properties more profitable. However, rental demand can fluctuate based on local economic conditions, demographic trends, and even changes in the housing market, such as increased homeownership rates. It's crucial to research the specific factors driving rental demand in a market, such as proximity to universities, job centers, and public transportation. By focusing on markets with strong and sustainable rental demand, you can ensure steady cash flow, even in less than perfect market conditions. By tracking these indicators more thoroughly and understanding their interplay, you can make more informed decisions and identify opportunities that align with your investment goals, even when the broader market conditions are uncertain. Practical steps to start investing now. If you're ready to start investing in real estate, as promised, here's a practical 90-day plan to help you get started. Day 1 to 30. Education and goal setting. Research and learn. Spend time learning the basics of real estate investing. Read books, listen to podcasts, and watch webinars to build your foundational knowledge. Set clear goals. Define what you want to achieve, whether it's generating passive income, building equity, or diversifying your investment portfolio. Your goals will guide your decisions. Assess your finances. Review your current financial situation. Determine how much you can invest, whether you need financing, and what your credit score looks like. Day 31 to 60. Market research and financing. Research markets. Identify potential markets that align with your goals. Look at factors like job growth, rental demand, and property appreciation. Explore financing options. Look into different financing options such as FHA loans for first-time buyers, conventional loans, or even seller financing. If your credit score is low, consider improving it or exploring alternative financing methods, such as hard money loans or partnerships. Get pre-approved. Once you have a financing plan, get pre-approved for a mortgage. This will give you a clear budget and make you a more attractive buyer. Day 61 to 90. Property search and acquisition. Start your property search. Use online platforms like Zillow, Realtor.com, or local real estate websites to find properties that meet your criteria. Attend open houses and network with real estate agents. Perform due diligence. Once you've found a property, perform a thorough analysis, calculate potential returns, do inspections, consider repair costs, and assess the neighborhood. Make an offer. If the property checks all your boxes, make an offer. Negotiate terms that work for you, and be prepared to walk away if the deal isn't right. Post-purchase, management and growth. Set up property management. Decide whether to manage the property yourself or hire a property management company. Ensure everything is in place before tenants move in. Monitor and adjust. After purchasing your property, keep an eye on market conditions, rental trends, and property performance. Be ready to adjust your strategy if necessary to maximize returns. Starting your real estate investment journey doesn't require perfect market conditions. It requires informed decisions, a clear strategy, and the willingness to take action. The sooner you start, the sooner you can begin building wealth and securing your financial future. Waiting for the perfect market is a mistake that can delay your journey to financial independence. The real estate market will never be perfect, but that shouldn't stop you from investing. By getting started now, you give yourself the opportunity to learn, grow, and benefit from the long-term appreciation of your investments. Remember, the key to success in real estate is not timing the market, but spending time in the market. Don't let the fear of imperfect conditions hold you back. Take action today and let the power of time work in your favor as you become a Realty Rockstar. Share and subscribe.